Hello, investors. Welcome to our podcast for the month of December. As we draw closer to the year end, it's good time to review your portfolio and see what has worked, what has not worked, and how you position your portfolio for next year. So we've been vocal about the 12, 20, 18. We think it works really well for the investors over the long run. Whether in 2023 also it's a good strategy. If yes, then why? And if not, then why not? Let's look at how the factors are shaping up. So again, in 2023, there will be numerous factors that will influence markets and therefore the performance of your portfolio. So if you look at inflation, how that's going to behave, how is going to be the policy response to slowing inflation, we are anticipating a slowdown in the global world, how that's going to impact your order returns. So there are, as always, there are so many factors that will influence your portfolio outcomes. So if you look at the markets the way they are geared today, next year there could be three scenarios largely that could pan out, right? One is stagflation, where if inflation continues to be higher, if there are more supply side bottlenecks or issues like we saw what we saw with Russia, Ukraine, if there is say a China, Taiwan, then probably that could lead to elevated inflation. So there could be numerous ifs and buts that could lead to various outcomes. So if there is a sticky inflation or slightly elevated inflation and slowing growth, that could mean stagflation. In such kind of scenario, equities may suffer, debt may be neutral, and gold could do well. Scenario two, where there could be a deflationary recession, inflation comes down, but at the same time, growth also collapses in the global world. In that scenario, also equities may have a tough time until policy response helps markets. So if central banks take a U-turn, and have to wait until then, and thereafter equities may rebound, but until then they may be not be doing well. Debt again in that scenario, until central banks start to become dovish and start cutting rates, debt may have a tough period, or markets may start anticipating, so it could be neutral to better outcome there. And gold could do well in that scenario as well. Third is a Goldilocks growth scenario, where the growth could the central banks could achieve a balance where they kind of tighten only so much that inflation comes down and growth is not impacted that much. In that kind of scenario, equities would do extremely well. That again would be neutralish. And gold could suffer in that scenario. So we don't know what exactly is going to pan out. Certain things look a consensus, like for example, slowing global growth. That looks a consensus largely. So what should be your approach? Is it equities or fixed income or gold? How do you pick the winning asset class? So don't get bothered by these factors. They are all noise, and every time we have seen many factors influencing market outcomes. Focus on what you can control. That is asset allocation. So we still think that 12, 20, 80 could be the right approach that you would have for markets going not only for 2023, but over the long run. And why we say that is because economies will go through the ups and downs, and these are often unforeseeable. Assets in our portfolio, due to their differing risk and return characteristics, will respond differently to these ups and downs. For instance, equities run up when the economy is doing well, and gold tends to shine when economy is down in the dumps. So in a sense, what we're talking about is, because it is difficult to predict with certainty the future of the economy, it is also difficult to determine the resulting best performing asset class. And that's where asset allocation and diversification becomes very handy. So let's look at the 12, 20, 80, and let's see if it makes sense for next year. 80, which has to be your core allocation, the bulk of your allocation into a wealth generating asset class like equity. Does that make sense next year as well? So if you look at how the Indian economy is shaping up, so if you look at domestic demand is coming back in a big way post pandemic. There are favorable demographics that will help Indian economy not only next year but going forward as well. The structural drivers like digitization and formalization are helpful. There is supportive government policies in terms of measures like we have seen, like the PLI scheme. Plus, we have a relative political stability. Uh, Inflation is moderating. There is uptick in equity savings. All this has set stage for a cyclical recovery, which is very apparent in revival in, for example, sectors that we are seeing pick up in real estate. IT hiring over last few years have been strong, which could be a driver of returns. There is corporate earnings which are very resilient and growing, as opposed to what we saw between 2017 to 2020. They were very flattish, and it was a P expansion story rather than earnings growth story. But this time around, earnings growth have been very resilient. There are strong tax collections. Capex is likely to pick up, driven by government capex, and credit growth is also higher. So, to make things sweeter, we are relatively better placed compared to other emerging and developed economies, which is also reflecting in Indian market valuations, which are higher than those economies, and that is for a reason. On growth and inflation fronts, we are better. Which should, over a period of time, help attract foreign flows as well, which were kind of on and off. We've seen largely outflows happening in Indian markets, but of late we are seeing some signs of revival in form of foreign flows coming in. And what's driving that really is the domestic consumption story that we have. So if there is a recession in the global world, it may not impact India as much as it will do to other economies, because if you look at exports, it's just 21% of our economy, and 70 to 80% is reliant on domestic story. Largely comes up private consumption making about 60% of the total. So overall, we are seeing the growth momentum continue. So if you look at various indicators, like for example, manufacturing and services PMI holding above 55, around that 55 level, anything above 50 suggests expansion. If you look at GST collections, they have been very robust. If you look at e-way bills, if you look at vehicle registrations, all signify growing momentum. If you look at credit growth, also it's been around that 15-16% mark year on year, which is also telling you that credit growth is picking up, which is a result of a higher consumption that we see in the economy. So overall, the flattish growth that we saw from 2015 till 2020, largely in revenues and in earnings, is changing. We have seen post-COVID, the revenue growth significantly improve. Along with it was profitability growth. Last 2 quarters have been difficult, but again, this we are expecting a turnaround because inflation pressures, which are impacting revenues and margins, have been going off or tapering. So we expect the earnings growth to continue going forward over the next couple of years. So given that the robustness of the equity story, equity has offered long-term growth potential, and that looks likely to continue over next couple of years as well. So it perfectly makes sense to have a higher allocation to equities, a core allocation of your portfolio, and should be around that 80% level after you set money for emergency reserves. That 80-20 should be 80, any money that you keep after 12 months of emergency money can be split into 80 into equities and 20 into gold. And if you're looking at that core allocation, why it makes sense, because India is on course for a real GDP growth rate of 6.5%, and which translates to a nominal growth of 11 to 12%, which has been the pillar for resilient long-term performance over last 20-30 years, and which is likely to set continue over the next decade or two. Now, coming to the other diversification block, which is gold, 20% allocation to gold. So we've seen that equities have delivered highest returns, but it also comes along with its own volatility, which is on a higher side. But equities and gold complement each other. So we have seen years when equities have suffered, gold has helped in terms of negating some of the losses that we have seen in equity markets. So why 20% in gold now? Does it make sense to own 20% in gold, or should be lesser, or should be higher? So if let's look at the overall portfolio construct. So despite India's long-term growth story being intact, despite the domestically focused nature of its economy, with consumption and investment making up the bulk of the country's GDP, equity markets are still vulnerable to external macroeconomic risk, like say a global slowdown, relative valuation correction, or on account of geopolitical tensions. So if you look at the growth forecast have been slashed to sub 7%, around the 7% mark, but that is still a respectable growth to generate decent returns. So we still believe that long-term sustainable growth rate of India should be around 6.5%. That should result in or translate to decent returns for investors over long time frames. So there could be equity market volatility or weakness because of external factors. Uh, Diversification of portfolio to include low correlated asset classes becomes very, very important. So gold has historically done well in times of economic or geopolitical turmoil when equity markets took a beating, making it an ideal asset class to diversify the current macroeconomic risk that we see today. Uh, uh, at the same time, there are certain triggers which could also favor gold, but you don't buy it for returns, you buy it for the risk mitigation that it brings to the table. So if you look at the scenarios that if say a Fed prioritizes inflation over growth and it becomes aggressive and keeps up with its interest rate increases, it could have a meaningful impact on the economic growth. And therefore, if there is a recession or an extended period of lower than average growth and higher average inflation, which is a stagflationary kind of scenario that we spoke about, gold could do well. Also, if there is, a U-turn by the Fed, so if say growth deteriorates significantly and they kind of abandon all the rate increases that they've done very sharply and start cutting rates and pushing in liquidity once again, then probably gold could do well. Only in a balanced scenario where Fed does only so much that it brings down inflation but does not impact growth, which is very difficult to achieve. That is where gold could not do well, but at the same time, your 80% will be doing well at that point in time. So overall, 20% in gold also does make perfect sense. So in the current market context too, the 12-20-80 asset allocation framework is ideal to capitalize on the upside potential of Indian equity markets that it offers today, while being able to persist amid the uncertainty and volatility created by higher inflation, tighter monetary policy, global economic slowdown, etc. With the help of backup cash, that is the 12-month, the 12 and the 12-20-80, the backup cash, the emergency corpus that you have built, which ensures you don't get pushed into redeeming your equity investments at the most inopportune time to meet liquidity needs. And gold, with its negative correlation to equities, can limit portfolio losses when equities falter in the recessionary environment. So I think 12-20-80 is a more time-tested allocation, and we have seen it work in most market scenarios. So if you're not allocated with 12-20-80, I'll urge you to look at the 12-20-80 framework. It works well and it's positioned very well in the current market context as well. So you could use simple tools on our website, and there's a 12-20-80 calculator which will help you allocate very, very easily with a few clicks. So I think please asset allocate, ensure that you are adequately positioned with this 12-20-80 approach, and hopefully you will have better portfolio outcomes going ahead as well. So with that, wish you a very good new year. The next podcast will be in the month of January, but until then, happy investing and wish you all a very good 2023. Thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.